Hi, this is Bitcoin Asset Research with Allard. Today I'm going to talk about MicroStrategy myths and misunderstandings, just doing my part to combat some of the FUD. Here's a quick list of what we're going to go through in the video. First up, we have MicroStrategy should trade at the same value as its Bitcoin holdings. Then we have the premium exists because people in some areas can only buy MicroStrategy and they're not able to buy Bitcoin. So MicroStrategy is the only available Bitcoin proxy. We have this funny one, which is that MicroStrategy is a Ponzi scheme or a pyramid scheme, or that its edge disappears when more companies start buying Bitcoin, or that its BTC Yield KPI somehow isn't real or is not sustainable. And then finally, the argument that MicroStrategy creates a centralization risk for Bitcoin. So here I'm going to argue why all of these things are false. So first up, MicroStrategy should trade at the same value as its Bitcoin holdings. This is wrong simply because it's not a fund. There's no share redemption or creation mechanism. You can't give Bitcoin and get MicroStrategy shares back. You cannot turn in your MicroStrategy shares and get the Bitcoin back. There's no market mechanism for MicroStrategy to trade at the same value at its Bitcoin holdings. Now, it's not even a closed-end fund. And it's not like a closed-end fund either. So a closed-end fund is just a fund that does not have the dynamic share redemption and creation feature, so it is able to trade away from its net asset value. And probably the best example of a closed-end fund is GBTC. Right before it got converted into an ETF, it held Bitcoin in a closed-end fund structure. And you can see that the premium to NAV has really oscillated throughout the last few years. It started off trading at a pretty high premium to its underlying Bitcoin value, and then in the last few years it flipped to a heavily negative premium or discount to its net asset values. Now it's important to note that this is not MicroStrategy. MicroStrategy is a company. The market value of a company in excess of its balance sheet value, in excess of its Bitcoin value, is the market's assessment of the company's ability to generate future cash flows. Now here's a quick hint. The cash flows don't have to be dollars, and accounting is a language, and language can be very limiting. If you've watched my earlier videos, you will know what I am talking about. Now on to the second piece of FUD. The premium exists because people in some places can't buy Bitcoin, so they buy MicroStrategy shares instead. First off, this overstates the impact of capital from such places. This is certainly a large amount of capital, but given the totality of the market, I would say that this impact is terribly overstated. They could also buy other equities like Bitcoin mining stocks, so MicroStrategy isn't even the only Bitcoin proxy which exists. Overall, this is a bad way of explaining the premium. It's kind of like saying housing only exists because it's illegal to camp in the local playground or park. Obviously, both things are true. Housing could exist, and it is illegal to camp in your public areas, but these two true things are not causally linked. So the premium is the market's expectation of the business's ability to generate future cash flows. For this, you really have to understand what exactly the business is, and really it is not software. It is not just a software business, and we're going to see that later on. If you like this video so far, I just ask you to like it, subscribe to the channel, share it with a friend, leave a question or a comment. I really think MicroStrategy FUD is some of the worst and dumbest FUD I've ever encountered. So I'm just doing my part to combat that, and I hope you can help spread the word. So next up, we have MicroStrategy as a Ponzi or a pyramid scheme. For something to really be a Ponzi, you must identify where it is that early investors are only being paid off by later investors. This is just the definition of a Ponzi scheme, and pyramid scheme is very, very similar. Here I'm using it kind of interchangeably, but really the nuanced differences are extremely small. So here's a few stipulations before thinking whether something is a Ponzi or pyramid scheme. Price going up due to new entrants doesn't immediately imply Ponzi or pyramid scheme. Price can go up due to new entrants for many things, like index funds is also one of those things where new entrants, new investors in the index fund will push up the value of the index. That doesn't make index funds a Ponzi immediately. Also, a cult following of the leader doesn't immediately imply Ponzi or pyramid scheme. MicroStrategy pays investors because it can generate a Bitcoin yield. This is really the return on investment. At first, the Bitcoin yield appears to be the product of new securities issuances, for example, convertible notes or at-the-market offerings. And this could seem very pyramid-like, since a base of new entrants who buy these securities are needed to create the BTC yield. But that is not actually the full picture, because you're really omitting a very crucial fact. MicroStrategy's true business model is to issue Bitcoin securities with a specific risk-return profile to specific types of investors. So the Bitcoin yield is not from newer suckers entering this scheme. The Bitcoin yield is from MicroStrategy providing a valuable service to society, and that service is taking Bitcoin's return and its volatility and restructuring it into various securities which fit the need of various investors. So this is a lot like an investment bank. And this is exactly what I argue in my previous video, Bitcoin's only investment bank. This is what MicroStrategy is, in my opinion. I definitely encourage you to give this video a watch and tell me what you think in the comments. Now, I do think there is another way to see it. If it was a Ponzi scheme, it should only need and have just one offering, just one product. Just sell the stock and keep increasing BTC yield. Why have 5 different tranches of convertible notes with different terms? Why discuss things like preferred shares and secured debt? Why prioritize option volumes and open interest? These are all topics that the company is clearly very interested in, because you can see here in these presentations, they talk about their volatility and the liquidity and the open interest of the options markets. Then they have this slide where they talk about how MicroStrategy dissects the returns of Bitcoin and puts them into these different tranches of risk and return categories. And here we even have this MicroStrategy share with dividend, and it's not yet available, but these are clearly allusions to some kind of preferred share offering, which will also have a risk return profile that meets a specific kind of investor that is not being addressed at the moment. So you really have to ask yourself, if it is a Ponzi, why bother with all of these different things? But if it is a valuable service, understand that the company absolutely must bother, because they need to be attentive to the needs of the market, right? If it was a Ponzi scheme, if it's a scam, just do one thing and just keep selling that one thing and scamming everybody. But if it's a valuable service, you absolutely do need to understand the broad cross-section of the market. Then you have this piece, which is that MicroStrategy's edge disappears when more companies buy Bitcoin or use its playbook. This is usually the critique after people start to understand that the premium makes sense and the company isn't a Ponzi scheme. So once someone is saying this, that means they're making progress on those other things that we talked about. But it is again missing the big picture. What these people don't understand is that MicroStrategy can do what it is doing only because it is so hyper exposed to Bitcoin via its capital structure. If a big company tried to get there, it wouldn't have the hyper exposure to Bitcoin to be issuing Bitcoin-backed securities. If a small company tried to get there, it would never catch up to MicroStrategy's enormous Bitcoin stack. So MicroStrategy's moat is extremely large. Anyone trying to catch up to them by purchasing that much Bitcoin, which at this point stands at almost 2% of the supply, they are going to rapidly drive up the price of Bitcoin and therefore enrich MicroStrategy shareholders and allow MicroStrategy to issue even more shares and buy even more Bitcoin. So not only does their edge not disappear when more companies start buying Bitcoin, if anything, the edge gets much stronger. And this is exactly what the company has been doing. They actively encourage people, like with this initiative, Bitcoin for Corporations, to use a corporate Bitcoin treasury strategy. So they're literally encouraging people to adopt it, because they know that this is their edge, and the edge of having the most Bitcoin will only grow larger once more people want your Bitcoin. Now, the next piece is that BTC Yield isn't real or isn't sustainable. First up, let's see what BTC Yield is. MicroStrategy announced this metric in their Q2 earnings call. See, BTC Yield, a key performance indicator for our Bitcoin strategy. And if you scroll down over here, it actually gives it a definition. The percent change period over period of the ratio between the company's Bitcoin holdings and its assumed diluted shares outstanding. And then it goes on to say that assumed diluted shares outstanding is basically the most conservative measure of how much shares there are, assuming everybody converted all of their options and convertible debt into stocks. This piece of skepticism usually comes from the question, where does the yield come from? And this is a very good BS test in crypto. When you're looking in crypto circles, you're going to see stuff like this. Where does the yield come from? Where does the yield come from? This is a very good question to ask. If you don't understand the yield, you are the yield. So it's definitely good to ask this question. In MicroStrategy's case, we've already discussed this. The yield comes from providing the valuable service of taking Bitcoin's return and volatility and then packaging it into securities that are perfectly tailored for specific investors. That's the service that's provided, and then the yield is generated off of providing that service. But sometimes the concern of this question is really over MicroStrategy's end game. And it really goes something like this. What happens when there is no more Bitcoin left to buy? Because a lot of commentators, they would say, hey, you're buying up all the Bitcoin. What happens when there's no more Bitcoin left to buy? So in that case, the Bitcoin yield must stop, right? Because you can't have more Bitcoin coming in. Well, that's actually wrong. So let's look at the definition of BTC yield. A period-to-period increase in BTC per assumed diluted share. So for the sake of argument, let's say that there are no more Bitcoin left to buy. Maybe MicroStrategy bought all of it. Maybe they are all in the hands of people who will never sell. First off, even if this situation emerges, let's just think for a second what that would mean for the fiat price of Bitcoin if you cannot buy it for any fiat price. But now just understand that MicroStrategy can still issue Bitcoin-backed securities which fit specific investor profiles, which is their business model after all. And then they can take that money, the proceeds from these securities, to buy back MicroStrategy shares. So if we look at BTC per assumed diluted share, that would go up because assumed diluted shares would go down. This is the fraction that you're talking about. So this is BTC yield, Bitcoins per share. And if the denominator is going down, then BTC per share is going up. So that's a BTC yield. So even if every single Bitcoin is bought up and no one is selling their Bitcoin, it can still increase Bitcoin per share. Even in the most extreme scenario, you can see that BTC yield does not just go away. But what's really funny is that the people asking this question are very often short-term thinkers, and they have never really considered the end game for anything else that has real substance. For example, what's the end game for printing trillions of dollars per year? What's the end game for debt trapping developing countries and the global south via the International Monetary Fund and the World Bank? What's the end game for real estate and stock markets being propped up by monetary premium because fiat cannot hold value? And so it's interesting that they're very, very loud when it comes to a company who just wants to buy some Bitcoin. And then this is the last piece of FUD, which I actually think is somewhat valid. MicroStrategy creates a centralization risk for Bitcoin. So we're just going to go through the worst case scenario, which is that they have to liquidate 2% of the entire Bitcoin supply. Now, this will certainly crash the price and lead to a cascade of liquidations and margin calls. Equity holders, that's the MSTR shareholders, will be wiped out completely, and debt holders might get some of the principal back in the form of the liquidated Bitcoin. It would pull down all the stocks with BTC treasury strategies because the treasuries would effectively have gone through a gigantic mark-to-market markdown. And of course, some corporate boards might even panic sell into the crash. So if the boards of various companies were a little bit unsure about getting into Bitcoin in the first place, and then suddenly they got into Bitcoin, and then suddenly Bitcoin dumped, they might panic and sell into this crash. And that would obviously make the crash even bigger and even worse. Option traders will buy puts on IBIT, on Bitcoin, on MicroStrategy, and this would accelerate a death spiral dynamic. Many miners will be forced to turn off because the plummeting Bitcoin price is going to make their mining operations unprofitable. If enough miners suddenly stop mining all at once, the network could actually slow down significantly. Now, in a really extreme case, the difficulty adjustment might not even be able to fix the slowness issue for many weeks. For those who don't know, the difficulty adjustment is what allows Bitcoin to maintain an average block time of 10 minutes per block. Most people understand these adjustments as happening once every 2 weeks, but this is actually not true. It actually happens once every 216 blocks. And of course, blocks are determined by how much hash rate is on the network. So if you suddenly drop 90% of the hash rate, blocks come out 10 times slower than before, which means that the difficulty adjustment that used to be 2 weeks long is suddenly going to take 20 weeks long. And here's another thing. The difficulty adjustment can only adjust by up to ratios of 4. So you can only get 4 times faster or 4 times slower. Now, what that means is if the network is 10 times slower, you obviously won't go back to 10 minutes per block anytime soon, because one difficulty adjustment would only get you 4 times faster, which doesn't address the fact that you would be 10 times slower. You would need multiple difficulty adjustments to really fix the issue. And then of course the problem gets even larger if 99% of the network suddenly turned off at once. Then it could take maybe months or maybe even more than a year in order to get the network working as normal again. But ultimately, in the long run, when all of this is fixed, Bitcoin will still be okay. MicroStrategy cannot override Bitcoin consensus or force any kind of hard forks. This is what's so important. Ownership of Bitcoin does not mean any control over the network. And that is thanks to proof of work. Don't get it confused with proof of stake, where ownership of the token does absolutely give you control over the network. So Bitcoin's price will be much lower, but the network rules will be the same as it was back when Bitcoin was $10 or $100 or $1,000. Throughout all of this time, Bitcoin has never really changed. The network rules have stayed consistent. One could argue that if MicroStrategy fails, it would be a decisively unfavorable turning point in the story of Bitcoin's adoption. It could set things back by many, many years. And certainly no publicly traded company will consider adopting Bitcoin for at least a decade. It would just give PTSD to people. So no one would ever consider doing it, and this would set back adoption by many years. We could also see unfavorable regulations, lawsuits, accusations of fraud, perhaps even the delisting of spot ETFs due to public pressure from all of this, right? So the fallout of this could be huge. And is this a centralization risk? Like, maybe it is. Like, this criticism has a valid point. However, you have to also realize that the emergence of this risk is basically inevitable. Whether MicroStrategy does it or someone else does it, someone was going to do it no matter what, and the risk was going to exist no matter what. You will always have big players that try to buy a lot of this asset, and this will be true as long as the fiat system exists. As long as there's a canceling effect, you will see things centralized within the realm of economics. So MicroStrategy might be a risk, but it's only a risk from a fiat perspective. It's not actually a risk to the technological innovation of Bitcoin, because that thing is designed to be perfectly anti-fragile, and as time moves on, it's just going to smooth out all of the problems that are thrown at it. And that's really ultimately the long-term picture of this. So that's the video. I hope you enjoyed it, guys. Thank you so much for watching. Leave a question or comment. If you liked the video, give it a like, subscribe to the channel, and I'll see you in the next video. Bye.